right, welcome back, ICA. Next, what we're going to go into is a concept and a situation called margin. Okay, the way that I would actually put it is it's playing with fire while covered in gasoline. Especially for newer traders and people who are just learning about the market, margin is not something that you want to be using or trading with. Okay. Um, First, what we have to talk a little bit about is the products and services that we do use. In the past, if you were to go purchase, stocks, you would have to go through your brokerage and you would pay a commission. You would pay them a fee in order to, take care of your trade. So if you're going to go purchase 100 shares of something, depending on your brokerage, it might be a flat fee or it might be a percentage of what you're trading. However, in today's world, with the advent of the cell phone and the internet and these things that allow us to trade in a much faster pace, things are no longer necessarily paper certificates that show that you have these stocks. And a lot of times brokerages have these digital means to help you get the documents, help you take care of what's going on. But as a result, it's actually turned into a situation where there are certain products that are offered, products and services that are offered in a no commission sense. Okay. And especially here, you and I have heard of these bigger names. There's the Robin Hood, options free options trading. You also have, Webull, zero commission. There's a lot of them out there, but these are kind of the two big names. I do actually still use them myself, but I want you to understand that there are certain conditions to the way that these products work. Okay. Instead of it being commission where they're going to get your, take your money in order to put those trades and, they can pay their people to do it, because this is a program and a computer that's doing it, they're actually going to take your data. Okay. They're going to use your data, and they actually have developed this third system that allows them to profit off of it. So because it's free to you, they actually still have a way to profit. As a business, there's no way for them to stay afloat and to, move forward if they're not bringing in money. There's no investor out there that's going to put money into a losing business model. So what is it exactly, what's going on? Well, yes, they're offering something that's free. But something that, my dad taught me when I was a kid is, there's no such thing as a free lunch. If there's something that's free, especially in business, what they're looking for, and oftentimes is they're looking for information or the possibility of making a sale in the future. So, in business, there's this saying, if it's free, it's because you are, okay? You're the thing that's free. What is it that you're providing that's free to them? Well, at the end of the day, there's this thing called payment for order flow. What payment for order flow is it's where an investor is actually putting a trade through their broker, okay? And through their broker, what they do is they actually find a third party that actually completes the transaction with the most favorable terms, okay? So here's kind of what you could imagine is, let's, instead of a stock situation, you could imagine you're going out there to buy a pair of shoes and you say, I'm willing to buy that pair of shoes for $100. Well, your broker is going to put that out there into the market, and this third party is actually paying the broker to send that to them. Okay. This third party has got a contract with him that says, for $100K a year, you're going to send me all of these. Okay. Because every shoe that I purchase, they're going to send it to the third party, and the third party is going to say, oh, he wants it for $100. Well, I'm looking at the market right now and I can buy it for 95. So they're going to pocket $5. They're going to give you your $100 shoe. That makes sense. And they're going to take your $100. Now the broker's already made their 100K off of it. They're sitting pretty for the year. And this third party is going to continue to scrape off. Now, keep in mind, it might not even be 100 to 90, 95. They might not even make 5%. That's actually a bit of an exaggeration in most cases. They're very likely going to make they're going to make cents in most cases. But when they have millions to billions of these trades throughout the year, that's where they're going to make actually quite a lot of money. Okay. So I want you guys to understand that payment for order flow is something that happens with the market and with the free commission situations. So if you want your orders to be put in to be unseen, in a sense, you don't want somebody else to find out what you're trying to buy, then ultimately you do have this situation where you would actually pay for your commissions. You would avoid these free payment or free commission type of trades. Okay. Next, what we want to point out is there's this thing called margin investing. Okay. And margin investing is this thing that can get checked off on your on your account. And a margin account, you can see, allows you to do a little bit more in terms of what's going on, in terms of your ability to do different types of trades within the market. To start off, especially those that are new to the market, this is not something you want to do. It does give you a larger amount of buying power. What it is it allows the margin, to explain it, is debt trading. It's DEBT, debt trading, right? Debt trading is a situation in which you're actually going to be borrowing from your brokerage and allowing them to front a bit of the money for you. A good example of this here, is it's a way of leverage. Okay, leverage meaning that you can imagine any sort of lever where usually it's equal, 1-to-1. In an equity situation, if a stock goes up $1, that's how much you gain. If it goes down $1, you gain 1. Okay. In a leveraged equity, or like our ETFs, those situations where we talked about, where it could be 1-to-3 or 1 to -3, where each dollar move here represents $3 in this one. Okay. Options, technically, in a sense, you can imagine your options, your one contract represents 100 shares. So it is another way to leverage your money and leverage also time, and ultimately potentially using something, technically this should be the opposite way, using something small to represent something big. But you got to remind yourself the risk is always going to be relative to the amount of leverage you're using. One of the issues that we actually are going through right now actually is the fact that our banks have this type of leverage too. Our banks, you can imagine, can leverage their money in a sense where $200 could represent $10,000. And that's a 50-to-1 leverage situation. In a margin type of situation with your account, what you can imagine here is, for example, you put in $8,000, and usually your trade for options or for equity would be $8,000 as well. So if it profits 200, your return's 2.5. Okay. What the company that you trade with, the brokerage that's offering you this margin type of trading, what they're going to do is they're going to allow your $8,000 to represent more, meaning that they actually will say, hey, put up $800. Okay. That $800 will represent this part of your trade. As a result, you're still making the same trade, but we're going to put up the other 7,200. Okay. The bank is going to do so. Therefore, if you profit with that $800, you profit the same $200, that's going to return you more. It's going to be a much, prettier return. Okay. So do you see how, it's actually fairly enticing? You're getting to use more money, because here, hey, what if we just put a 0 here? We're going to use our whole capital, right? Put a 0 here, and now it represents $80,000. And now our profit's going to be $2,000, okay? Which is going to be really nice, 25% return. But keep in mind, with every risk that we're taking, right? This almost seems too good to be true in a sense. Well, here's the thing. Here's a risk. If that $8,000, right? $80,000 is a lot of money. The bank's going to put up $72,000 for you if you're going to put in $8,000, okay? You only put in 10% here. That $80,000, what if that went down to 70? Okay. So now you've lost 10K. Your portfolio was only 8. Well, actually, now your portfolio's down to a negative 2,000, okay? Which ultimately means now you're gonna have to owe your bank account or owe that brokerage money here. And ultimately, they're gonna bug you for it, or eventually, close your account and all that and come after you. So there's also situations to be very careful about where margin is trading with money you very likely don't have. That's actually the appealing part of it to most people. But you can imagine, why is it that they do this? Well, at the end of the day, this creates a situation where you're more likely to become the liquidity for the market too. You also have a situation where you're more likely to purchase and sell more, stocks and options with margin, and as a result, it's actually going to give them more data in their payment for order flow, or give them more data in terms of what you're willing to buy and sell, which they can make decisions off of. So understand here that margin, we want to warn everyone in ICA and everybody in ICC about this, because margin is a situation that if you don't know what you're doing with this, very likely or very potentially could lead into a very dangerous situation with it, okay, where you could potentially end up owing more than what your account is worth. And this has happened with quite a few people when it comes down to, if you look up the word margin calls or margin trading on Reddit, you've got these situations where you've got people with minus 70, minus 60, minus 99%. And here's even one where this guy was trading SPX options, weekly options that are extremely, extremely risky. And within a month, he said he actually now has a debt and owes a margin debt of $250,000 here. Here you have this guy on their Robinhood showing a negative $368,000. So, I want you guys to be aware in your account, make sure that margin investing is checked off or not checked off. Make sure it's unchecked so that you can be sure that you don't end up in this situation. What's important for the newer beginners is to use your cash account, right? What cash is in there is all that is able to be put in and to be used. Now, I want to also point out, margin is something that bigger investors and banks and institutions are using too, but it also is something that poses a bit of a danger. So you can imagine the way that the banks recently that had their recent bank failures, how they were leveraged in a way that they only need 10% of depositors' monies as a fractional reserve banking situation. That's a bit of leverage, is because they can put their money into things without having to hold on to it, okay? And there's a lot of these things that were a bit of a chain reaction from before. We have Archegos, which was back here in March, mid-March, end of March of 2021. And what you'll notice here is the fact that he had leveraged his money in a manner where it really, number one, didn't make sense, but also number two, he had to find a way to mask his losses and continue to purchase. Once one of the dominoes fell, where one day he had a Viacom CBS started to tank just a little bit, his portfolio was taken by his brokerage, taken by the lenders that loaned him money, and ultimately took back those shares and sold them off back into the market, which caused a very, very large drop and a sell-off. And you got to remember, this type of situation is also just a market cycle. These moments of euphoria, these top points of the market, are often due to the overextension of greed. And when it all comes in together, when everybody in the public is starting to look at how, hey, they might be able to profit from it, is when things start to go south. You can think about that about Bitcoin when it was in the 60K range. You can think about that with GameStop that we just talked about as well, and other squeezes where ultimately these cycles are due to the influx of money and the cycles of money and how they continue to go back and forth over time. These, these situations also have happened throughout history too. When you look at previous things in history, this is what would happen with the aviation, with the television companies, and these other situations where everybody thinks it's the next big thing and that nothing can fail. It's always going to keep going up. And that's where you really start to have the prices start to fluctuate and to come back down to earth. Additionally, you can think about PE ratios and how things are overvalued in those situations too. One way that this also happens is because institutions, and when money is plentiful, there's a lot of borrowing, there's a lot of you can imagine there's fraud as well when it comes down to those big money interests, where they may be representing that they have more money than they actually do. And this is something that has happened with, over time, where when lenders become more relaxed with money because it's plentiful, they start to lend it out too uncautiously. And as a result, there are going to be crooks that end up borrowing money with the borrowed money that they already had, and therefore they multiply what they have, but ultimately create a big bubble. All right. Our crashes are related to over leveraging and greed when things are prosperous. And you can imagine, that even the tulips hit a peak where they say it was worth 10 times the annual income of a skilled artisan. If you just use basic thought of 100K as what a skilled artisan would make in our time right today, 10 times would be $1 million. So imagine that a tulip bulb or something that represents money, represents wealth, is $1 million minimum. Okay. Well, think of it how NFTs and those Bored Apes were being represented with the Bitcoin craze and all that. $1 million for a Bored Ape because it represents wealth. That's kind of like the tulip craze when you think about it. And when you go look back on our crashes and the way that economic cycles work, the crash of 1929 was innovations like the radio, automobile, aviation, telephone, electric power transmission were deployed and adopted. And the companies that were using these and were poised to grow got a bunch of money within them. But what ends up happening a lot of times with the way that money works is just because the money's there doesn't mean the infrastructure, the capital, it hasn't been put to work just yet. And as a result, you have to think of that it's going to take time. Once that money's been put in there, it does eventually get sucked out by the bigger money interests. And if it, the company is able to withstand that cycle, right, coming back and continue the upward trend, that's where they end up becoming profitable and end up, winning out in terms of the future. But again, margin, leverage, what can happen is that situation where that investor, such as Archegos, borrows money to buy the stocks, but then the stock price suddenly does shrink, and then the lender, their contract demands that money back. They in their contract, it says they can actually seize those assets, seize parts of that portfolio, and therefore sell it back to the market. And that's why you can see how it had this giant drop off, because it was being seized. His portfolio was seized and they sold it off in order to recuperate the losses that he incurred. So leveraged equities and your options and margin trading do end up with this type of danger. Okay, so be careful. Margin is something we definitely want to warn you guys about. And for those that don't understand, especially newer traders, make sure that you do not have this checked off on your brokerage. Especially go into your settings. If you guys still have questions, make sure you bring them up with Kimo and I so we can help you guys figure that out. With that being said, that's what I got to say about margin. Hope you guys enjoyed that one and learned a great deal about it. I'll see you guys in the next one.